last half day we're going to spend together. We ended yesterday talking about responsible and ESG investments, and we're going to start today with the first panel talking about how to diversify investment for pension funds. And we'll go on with a second panel talking about a very important issue in Africa that has been mentioned many times, is how to grow the coverage and through the micro pension system. So that will be the second panel. And then afterwards, we will have the conclusions with the communique of this edition, and we will have the pleasure to know where will be the next meeting and the next annual meeting next year, the 7th one. And you'll know that at the end of this morning. So we're going to start with the first panel. So same way that we used yesterday, presentation, 15-minute presentations, and then the moderator will call the speakers, and you will have to talk for 55 minutes. So please welcome Mr. Richard Mark Davis, Senior Financial Sector Specialist in Finance, Competitiveness and Innovation Global Practice at the World Bank. He will present how to unlock opportunities for pension funds investments. Richard, the floor is yours.
Thank you so much. So it's a pleasure to be here this morning with you. It's been a wonderful conference so far. Thank APSA for inviting me. Last night was a blast. Thank you, ACAPS, for your fantastic work hosting. It's been fun to see colleagues from IOPS and also counterparts that I've worked with over the years all around the region. So we are going to dive into this topic of investment, unlocking investment. I'm going to take a small diverging path, though. I want to talk a little bit about a recent kind of publication that's on this same topic, but it really looks at this challenge of how do you unlock, you enable pension funds as local investors to be more effective. So very quickly, we've all seen some of these numbers in the past. There's immense amount of funding that's needed to help fund sustainable development. Just by virtue of how big these numbers are, a lot of it's going to need, it must come from the advanced economies. However, although that's where a lot of the assets are and that's where a lot of the money is going to need to come from, it is important that we unlock more local investors to make a difference in this critical area of sustainable development. So one of those local investment entities that we want to look at, of course, is pension funds. Why do we want to unlock more local investors? So we know that funding from advanced economy investors will often be skittish. It's often going to go away just when we need it the most. So we've seen many examples of this in the past, all the way back to the global financial crisis. You can see kind of the scale is the amount of money that was withdrawn from emerging markets when bad things happened. So during the GFC, money went away. Money went back to, call it, kind of safe assets, risk-free assets. You can see this also happened during the 2013 taper tantrum. It happened during 2015 when Chinese stock market issues emerged. It happened, of course, during COVID-19, and not shown on this chart, but it did happen again in 2022 when U.S. interest rates went up pretty quickly, and again, about 50 billion was withdrawn from emerging markets. So having more local funding that's going to be patient and willing to stay is a critical thing. So what needs to be true, and one of the things that the paper talks about quite specifically and early on is what needs to be true is pension funds are not development banks. They ought not to be looked at as just a source of capital. They have a job, and that job is to fulfill these long-term promises that have been made to many people, hundreds of millions of people that are in these plans around the world. And the first job of a pension fund is to pay those benefits. And so to protect their capital, to protect it in real terms after the impact of inflation is the key first job of a pension fund. So long as that's true, though, that doesn't preclude pension funds from doing other things. Ideally, that's very specifically stated as a secondary or complementary objective of being involved in the local markets as local fund providers. And that's really a great kind of secondary thing that a pension fund can do, because a pension fund is a 30, 40, 50-year entity that can be patient, that can make long-term investments, that can be the kind of stable force that you want behind the scenes, and not a skittish retail type investor that's going to jump in and jump out. But first, with the precondition of pension funds knowing how to prioritize their objectives, the second thing that needs to be true is governance needs to be up to the task, fit for purpose. So investing in short-dated government securities, investing in bank deposits is relatively easy for a pension fund. Of course, there are intricacies, but really investing in those kinds of investments is doable. Investing in some of these other, though needed, instruments is harder. And so as we ask pension funds as local investors to take a larger role, we need to make sure that they're up to the task. And so education, pension fund trustees, getting them the capabilities and skills that they're going to need needs to be an ongoing, not one time, but kind of consistent job that gets done year after year after year as new trustees come on, as others roll off. But keeping those boards up to the level of skill and capabilities that they're going to need to be able to invest in some of these different types of assets is a critical precondition. There's a nice work that was done a number of years ago about the model of Canada. Now, Canada is known today with their pension funds as some of the best investors around the world, with incredible internal staff that do a lot of their own investing versus using a lot of external management, which you'll find that elsewhere in the advanced economies quite commonly. But they have these very capable governing boards. But that wasn't always true, and they weren't always well diversified. Even as recently as early 90s, in the case of Ontario Teachers, you can see they had pretty much just fixed income investments. I think these were largely non-marketable government securities. But they quickly kind of recognized the need to do more and to diversify, and they built up the capabilities and skill level of their governing boards. Their governing boards are famously independent nowadays, and so they do quite a bit of work in infrastructure investing and other asset investing, but they do this because they have these highly capable governing boards that can say no when they need to say no, that say yes when they see a really good proposition. And they do this largely internally. So a great model to look at. Another example that we often talk about with clients is the Malaysia Employee Provident Fund. Now you can see relative to a couple of the other entities in the region, the Malaysia EPF is a very large fund, over 200 billion. And they are quite a bit more invested in equities. You can see how much higher that is than the other two comparators. And then also infrastructure, it's 5%, so not a huge number, but a lot more than what their peers are doing. And then also they're doing a lot more international investment. So all of these things, I would argue, are indicators of a much more advanced approach that they're taking, and therefore they're able to make sure that they can deliver on the promises that they've made to their participants. One of the things that the Malaysia EPF has done particularly well is, well, really two things. One thing is they've been very intentional about capital market development happening at the same time as they diversify. So it's sort of a synergistic process they view it as. Another thing that we will talk to clients about often is they do a very intentional job of getting into new asset classes with external managers, but then having their own people train alongside those managers and eventually taking over some of those asset classes themselves after learning their way into it. Another tactic, let's say, that's been used here in the region, and it's a pretty recent phenomenon here, but it's been going on for a while elsewhere, is this idea of pooling, of pension funds getting together and not trying to go it alone, but rather pooling their expertise. So KEPFIC is a recent version of this, really, in Kenya. You can see the Asset Owners Forum in South Africa. So it's still early days for a lot of these pooling kind of entities, but so far so good. The Pacific Island Forum. Fiona was making me aware of a much more kind of mature version of this in Australia, IFM Investors, which is, I think is approaching 200 billion US in assets under management. It has over 700 client funds that participate, but it's largely an infrastructure-oriented pooling entity that's co-owned by something like 20 of the Canadian or the Australian super funds, and a really nice example of getting together pooling. Pooling isn't easy, and there's a whole range of decisions that have to be taken when you decide to pool with other pension funds. It could be as loose a confederation of just talking to each other regularly, or it could go all the way to something like IFM Investors, where you're co-owning an entity that does the actual investment work for you. So there's a lot of decisions that you have to take, like to what degree will you retain autonomy? To what degree will you work together? So it is, again, the message would be not simple, but a worthwhile thing to think about and contemplate for your pension funds. So let me talk specifically about some of the options that are available as local investors, as pension funds contemplate this kind of work. This is one of my favorite slides. I won't go into the depths of it because it's too much, but the basic message of this slide is, if you think about risk only in short-term terms, like what's going to happen to an asset in the next year, you're not thinking about it correctly, because its risk in the short term is very different than its risk in the long term. So the vertical axis is risk in the short term, and this basically just shows what is the depth of decrease that a given asset would experience, or a given portfolio would experience, in a basically like a 3 standard deviation tail event. And it could be as deep as a 35% loss in value for a portfolio if you hold largely just equities. Meanwhile, though, if you just look at that kind of risk, you're missing the longer term picture, which is on the horizontal axis, you see what is the risk that you actually destroy value in real terms over 10 years. And you can see for the portfolios on the top, which are largely fixed income, they look really good from a short-term standpoint. They only have a 5% loss in value in a 3 standard deviation tail event. But over the long term, over 10 years, they're almost certainly going to lose value, destroy value after inflation. So thinking about risk only in short-term language is wrong when you think about what's going to happen over 10 years net of inflation. So what are some of the options that pension funds can consider? Infrastructure debt and equity obviously needs to be a part of the equation. Infrastructure equity globally, you see it delivering about 7 to 9%. It's got volatility lower than other equity, but it's higher than bonds. You also have an unlisted version of this, which is going to have lower volatility, but you're going to have a lot of illiquidity question marks that you need to consider. There's some entities already in the region that are working in the area of infrastructure equity. Infrastructure debt, I was just recently made aware the IFC has a vehicle where they have a number of different types of investors, endowments, sovereign wealth funds, but they're specifically working with pension funds in some instances and offering them what they call a B-loan tranche. So this is where the IFC invests alongside the pension fund. They put their own money at risk alongside the pension fund, and the pension fund has the advantage of having some of the expertise that the IFC brings. This is actually quite large already. There is over 300 projects and 13 billion deployed all around the world, but the single biggest region where this money is now deployed already as part of this program is Africa, over 25% of the funding. Now, interestingly, though, not any of the pension funds from the region have started to participate yet. So my IFC friends, of course, were happy that I was going to talk about their program. But I think it's a good example of an infrastructure debt approach that could be viable. Private equity venture capital. It is obviously one of the other kind of key areas where the pension fund should consider participating. 11 to 14% net of fees globally, but you have the problem of cyclicality and a lot of manager dependency. So the point here is that if you pick the wrong general partner, this could end up faring even worse for you than just investing in public equity. So picking the right general partner in a PE investment is very important. VC, about 10 to 13% globally, and again, very high dispersion of results. Unfortunately, in Africa, the PE and VC deal counts declined in 2023. PE rebounded, but VC remains somewhat low. But average deal value has stayed high. So this is from a recent IFC paper where you can see the trend in blue of the number of deals declining, but you can see the average deal values getting higher again in 2024. The lower right-hand side just shows the nature of investee companies, you know, from fintech to IT to e-commerce, the kind of companies that have been invested in at various deal sizes. REITs and corporate bonds, these are, of course, other viable options. The markets are rather immature, though, so far in the region. Now, globally, 8 to 10% have been the REIT returns, moderate to high volatility. You can see these sometimes move with equity, so sometimes you don't get as much uncorrelation, there's a word there, lack of correlation as you'd want to, but it is a good vehicle. Corporate bonds, much lower returns, but also much lower volatility. You see some REIT activity, of course, in South Africa, but not a lot elsewhere just yet. A few instances. Corporate bonds are a little further along in other parts of the continent. End of the story. I mean, we want the pension funds to play a larger role. It's a needed ingredient in funding more of the sustainable development locally to get those patient long-term investors involved. But there are key things that need to be true. The priority of objectives, the governance strength, and then perhaps considering some of these tactics that can be considered. Thank you.
Thank you so much, Richard. And thank you for the presentation. To open this first panel, and that will be moderated by Mr. Amos Muji, Specialist, Capital Markets Financial Sector Deepening at FSD Africa. So please welcome Mr. Muji. Mugi, sorry if I mispronounce it. Do you want me to introduce your speakers? Yes. Okay, so your speakers will be Mr. Tapologo Mochubi. So please welcome Mr. Mochubi, who is Council Chair of the Pan-Africa Fund Managers Alliance. Mr. Chris Olobo, Chief Executive Officer of the Damana Guarantee Company. Mr. Mohamed Abou Majd, de la CIMR, la Caisse interprofessionnelle marocaine de retraite, from Morocco. Mr. Ogouche Aguda, Chief Executive Officer of the Pension Funds Operators Association of Nigeria. And Dr. Sarah Aliufo, Manager, Pension Supervision Bank of Tanzania. Right, Amos, so you have a microphone next to you? No? On n'a pas les micros. Okay. Can we have the microphones, please? Est-ce qu'on peut avoir les micros? Ça serait un peu plus, ça serait un peu plus pratique. I'll give you mine while they're coming, so you can make an introduction.
Yeah, for sure. Thank you so much, delegates. It's good to see you all today. I'm excited, especially after last night's dinner. I mean, one of the functions that I have to do in this panel is to make sure that everybody is attentive. Yeah? So So in terms of order, you will both be my co-moderators and panelists as well. Obviously, having the team in front of me, so feel free to ask all the questions that you have in your mind, and feel free to also chime in into this important topic. I also have to appreciate Mark for setting the scene in terms of the conversation, and I think, so we could start now, and I will start with you, Tapologo. So you're the chairman of an Africa-wide Fund Managers Alliance, yeah? So please tell us why it is important for fund managers in Africa to come together, right? And essentially what, the Alliance deems to do.
Thanks, Amos. The Alliance was incubated by FSD Africa in 2023. Its objective was to bring together Africa's asset managers. Bring together Africa's asset managers in a bid to speak with one voice as the African asset management community. There are a number of issues that we face as an industry. These issues directly impact the constituents that we serve and the countries that we live in. And a lot of those issues are very, very weighty, have very significant impact on our future. A lot of them have been discussed over the course of yesterday. I won't run down the laundry list, other than touching on just a few. For example, the types of instruments that we have available to us to invest in on behalf of the people that we serve are not adequate. Issues around sustainability and how we actually make our investments, not only at the fund manager level, but also how the people issuing the investments that we need to think about. There's a lot that needs to go into that. And before PAFMA was founded, what we found is that, in essence, this country's dealing with its issues and another one's dealing with that issue. There's very little cross-border collaboration. And so the idea of PAFMA getting together as one voice was quite revolutionary from my perspective. So far, we have 23 members. That membership is growing on a steady basis. What we're busy doing right now is capacitating PAFMA to serve the asset managers on the continent effectively, such that we're delivering true value to our ultimate constituents. So, in brief, that's what PAFMA is about, and I'm very excited about its future.
Yeah, thanks, Tapologo. We'll hear from you what are the opportunities and challenges that you're experiencing a bit later. But let me, turn to Sarah to speak about what is the regulatory journey in Tanzania around mobilizing capital from, pension funds to invest in alternative investments. Yeah.
Thank you very much, Mr. Amos, moderator, and I thank you very much for being in this panel. I also acknowledge my fellow panelists and the presenter. With regard to Tanzania, structural pension fund, most are the government. We have 4 pension funds, which are bigger, and we have private pension funds, which supplement the mandatory, so they are 16. How regulator regulate the pension funds? We have the investment guideline, which assists the pension fund trustee in making investment decision. Also, the guideline also provide for the limits in different investment categories of assets, whereby the pension funds are required to observe these limits. The guideline also prescribes some of the corporate governance issues to ensure that at least in decision-making, especially investment decision, are made under committees and properly. Also, the guideline also require the pension funds to have policies that all investments which are made and in those assets are within the policy. And the policy is being followed by the Board of Trustees and also the management. And the policy reviewed at least annual to accommodate changes into the regulatory requirements and in the pension funds operations. The limit, especially in the real estate. We are not far from other jurisdictions that pension funds are investing into the government bonds because of the risky factors. So even Tanzania, most of the investment are in the government bonds. Also, the second part is on the real estate because of the impact. So they also invest into the real estate, and the limit for investment into the real estate is 30%. And within that 30%, there is a limit because they can invest 30%, however, you can find that they are becoming non-performing. They don't bring in returns. So there are a limit of 5% that the non-earning real estate properties should not exceed 5% within that category. Also, there is a limit into the equity, investment in equity, which is 20%. And out of that, because of the risk in the unquoted equity, 5% should be only into the unquoted equity. We have the limit also in infrastructure because pension fund in Tanzania also invest in infrastructure, which is limit is 25% of total investment. Also, we consider returns. When they are making decisions, they must consider return, as the presenter also highlighted about the importance of the returns during investment decisions. So during the making decision for pension funds, they must make sure that investment in other categories apart from the government, the return should not be less than the government security of the same maturity during that time of investment. So they make sure that if it's in real estate, the return must be at least more than the government security of the same tenure and at the time of investment. For the lower returns, pension fund usually come to the central bank to request for the waiver. So the central bank will make analysis and make decision based on the impact of that project. So there's always that chance. Investment in properties, because of the associated risk, there's a requirement into a guideline that there must be managed by the property managers who have expertise in the management of those properties. And even in the construction of the properties, the pension funds are not allowed to construct themselves. They need to have independent third parties who are approved by the relevant authorities, who have expertise into the construction purposes. This to protect the pensioners' funds. Any investment in real estate in Tanzania must be approved by the regulator, apart from the government bond and all those, because the government bond are low risk. So in real estate, they must be approved by the regulator, who is the Bank of Tanzania. So what are available investments in real estate in Tanzania? In real sense, pension funds are contributing much to the economic development into the context of Tanzania. So they participate into the building of the long buildings, especially for hotel, offices, also in apartments, and the bridges. So they are contributing much in that area. Also, with regard to the unquoted shares, also the pension fund, they are buying equities, unquoted share to some companies, private companies, especially to add value to the agricultural products. And this has been having a lot of impact to the agricultural product and the job creation. So the pension fund have shares in sugar processing industries, leather processing, beef processing industries, and the sisal processing industry. So this is to assist the farmers and to add value into the chain of production to make sure that at least the farmers can be protected rather than selling the raw products. At least their products can be added with some values so that they can get good price of their products.
Okay. So Sarah, so allow me to come in first, because I mean you've given the spectrum of instruments that are allowable within the Tanzanian regulations, and we've seen that in Tanzania most of the alternative investment assets have to be the pension funds have to seek permission from the Bank of Tanzania, the regulator, to be able to invest in that. But maybe I could come to you, Mohammed, just to see, you are one of the bold pension funds that have invested in private equity. I could hear Sarah speaking about risk, return, right? But you've gone forth, aside from property, gone forth to invest in private equity infrastructure, right? But those investments are considered or are perceived to yield lower returns compared to, of course, the government counterparts. Would you tell us why you have invested in that and how your portfolio is performing? So,
No,
sorry,
no.
so Mohammed is going to make his submission in French, so we can transition. Yeah, over to you, Mohammed.
I'm sorry for that. Juste sur cette question de performance, séparer deux phases importantes dans l'industrie de private equity d'infrastructure au Maroc. Il y a une première phase qui a démarré vers les années 2000-2004 à peu près. Je vais dire jusqu'à 2015. Peut-être qu'il y a des GPs ici marocains qui peuvent me corriger un peu les dates. Et c'est une première phase qui était un peu d'exploration, où certains fonds ils ont réalisé une création de valeur importante. D'autres, ils ont sous-performé. Et pour des raisons diverses et variées, parfois une faiblesse de la gouvernance, manque d'alignement entre les GPs et les LPs, manque d'opportunités de pipeline et manque de capacité de sortie, enfin d'opportunité de sortie, d'exit. Donc tout ça a fait que globalement, statistiquement, on était resté un peu square. Dans ce que je dis dans ce propos, il n'y a pas de marque de regret parce que c'est une phase qui s'est soldée avec une bonne création de valeur quand même. Et c'est une phase qui a connu l'émergence de private equiteurs, si je peux l'appeler comme ça, qui sont talentueux et qui sont aujourd'hui en train d'offrir le service de private equity de haut niveau. La deuxième phase que nous sommes en train de vivre aujourd'hui, c'est une phase qui vient dans un contexte complètement différent, qui est sponsorisé par le Fonds Mohamed VI pour l'investissement. Très sérieusement, ça veut dire le Fonds Mohamed VI pour l'investissement, il pose l'argent sur la table, à peu près 30% par fonds de sponsoring. Il prend en charge les due diligence, il prend en charge pas mal de choses. Donc nous, on passe aussi une couche additionnelle, mais il y a un travail de fond qui est fait. Et c'est une phase aussi qui vient dans un contexte économique différent. Aujourd'hui, la croissance marocaine fait que nous avons besoin de PME plus capitalisées et plus fortes. il y a aussi des sujets de transmission parce qu'il y a des générations d'entrepreneurs aujourd'hui qui cherchent des plans de succession. Donc ça aussi, c'est un sujet de private equity et aussi d'infrastructure. Les investisseurs institutionnels, ils sont aujourd'hui dans des capacités importantes pour pouvoir suivre, enfin investir dans ces instruments. Et puis, il y a le paysage des GPs aujourd'hui qui est prometteur, il y a des équipes talentueuses. Donc tout ça fait qu'aujourd'hui, on peut dire que les perspectives de private equity d'infrastructure au Maroc sont très intéressantes. Et de toutes les façons, on n'a pas trop le choix. Nous sommes une caisse aujourd'hui dont le bilan s'élève à peu près 12 milliards de dollars, avec une bourse qui reste restreinte par rapport à cette taille. Et on n'est pas les seuls. Donc il y a plusieurs institutionnels qui sont dans la même bourse. Donc on est obligé d'aller chercher de la valeur sur l'equity ailleurs. Je rappelle juste que plus que 50% du portefeuille de la CIMR est investi en equity, entre private equity et public equity. Donc, pour revenir à la question de liquidité, comme ça a été dit tout à l'heure, nous sommes une caisse qui est excédentaire. Donc, les liquidités, ce n'est pas une contrainte, c'est plutôt, comment dirais-je, c'est un choix assumé, c'est un trade-off en faveur de la création de valeur à long terme, puisqu'on n'a pas besoin de coupons tout à l'heure, mais on a besoin plutôt de valeur ajoutée à long terme. Et il ne faut pas voir les instruments de private equity et d'infrastructure en comparaison avec des benchmarks de tout ce qui est action cotée. Parce que tout simplement, ça apporte autre chose, ça apporte de diversification de la stratégie, ça apporte de l'innovation, ça apporte aussi une connexion à l'économie réelle. Il y a plusieurs secteurs aujourd'hui qui ne sont pas représentés à la bourse de Casablanca. Donc on est obligé d'aller chercher ces thématiques auprès des private equiteurs. Et puis, je ne me permets pas aussi de comparer les deux parce que ce n'est pas la même phase. L'action cotée serait, ou la cotation serait pour nous la phase finale de toute une aventure de private equity qui démarre depuis early stage, VC, croissance, transmission. Enfin, vous connaissez un peu les phases. Donc, je pense qu'aujourd'hui, il n'y a pas de crainte d'aller vers le private equity et d'aller vers une gouvernance solide et une discipline dans la sélection et dans le choix des thématiques. Et puis, il faut aussi aller chercher la diversification constante, que ce soit dans les stratégies, que ce soit dans les millésimes, et que ce soit aussi dans la diversification géographique. Et ça, c'est une expérience que la CIMR a menée depuis 2018. De 2018 à aujourd'hui, je pense que nous avons investi 16 participations à l'étranger, principalement en Europe, parce que c'est ce qu'on sait suivre. Et bien que ça reste récent et que la J-Curve, enfin, on est en train de la quitter maintenant, mais quand on regarde un peu nos tableaux de performance, on est dans des choses qui sont rassurantes aujourd'hui. Voilà. Je ne sais pas si j'ai répondu à la question.
Yeah, you did very much well
merci.
answer to the question, and you went beyond that. So I hear you and have two takeaways from what you did say. That first, you don't have a choice in terms of backing entrepreneurs, which is a very good point that I take away from your conversation. The second point that I take from you is that, there's no worry in investing in private equity. That's a point that you did make, that pension funds and even the regulators in the room should understand that there's no worry in investing in private equity. But there's a but here that I'm going to bring in, and Chris is going to help me with that, because Chris, you work on credit enhancement and guarantees to make sure that pension funds are comfortable to invest in these particular assets. In the continent, most of the investments are in government securities. So how do I convince a pension fund manager or a pension fund trustee to invest in alternative investment, given the amount of risk that is seen on those asset classes? So over to you, Chris.
Thank you very much, Amos. and it's a pleasure to be here. I really like coming to APSA events. You pick the best venues, so I'm really happy. So the name of Damana is very important to me. It is really African-centric, and what Damana means in East Africa, I'm based in Nairobi. We cover Kenya, Uganda, Rwanda, and Tanzania. What Damana means is something that is valuable. And I also think in this part of the world, it means something that has value, okay? So as a guarantee company, our role is to guarantee that value. Now, Amos, when you invited me to the APSA event last year, we were just in the process of fundraising for Damana, okay? We closed our fundraising 6 months ago with $200 million capacity. Now, that investment is coming from a pension fund, the county pension fund in Kenya. It's coming from the African Development Bank, and it's coming from the UK government through FCDO. But we also have support from FSD Africa, so thank you very much. Now, we have already raised the money, and I can tell you we also have additional $200 million capacity that we're going to close by the end of the year. So we will have $400 million that we should help pension funds deploy into the economy. When you invite me for the next APSA, which I hope you will, I should tell you what $400 million is doing and solving a problem. What is a problem that we're trying to solve, at least in East Africa? Supervisors, and you're so many here, you are supervising funds that are investing 80 to 90% of their assets under management in government securities. By doing that, it's not a bad thing, but you're actually strangling economic growth in your countries. That money can be used in the real economy, infrastructure projects, and the return will be much better. But are those schemes doing wrong when they invest in government securities? I don't think they're doing wrong, okay? They're investing in government papers because of 4 reasons, okay? The first is they perceive government paper as safe, okay? They also don't have to spend any resources when investing in a government bond. They don't need to hire credit teams. They don't need to hire lawyers. When a prospectus is available, I tell you, your pension funds will make a decision in 2 seconds, okay? Once they have made the decision, they don't have to invest in portfolio monitoring. I don't know of any pension fund that has to monitor their government bond investment. They don't. Just, buy this and sit and report to the supervisors that you're making money, okay? And then they also hope to earn a return, okay? Many of the government securities in Africa, 15, 20, I saw some places 30%, okay? And then last but not least, when you look at the prospectus for government bonds, the government will tell you, if you give us money, we're going to use this money to do the following projects, okay? But in reality, government doesn't really spend 100% of what you give them on those projects. Part of that money is for recurring expenditures, like paying for salaries and all of that. So that is how you are strangling growth in your countries. So how do we then get these pension funds to move away from government securities into the real economy? And that's where Damana is coming, okay? So in the ideal world, what I would want is a government to tell you, don't give me the money, all right? But take this money and invest it in the following project. If that project fails, I, the government of Rwanda, I, the government of Kenya, I will make you whole, all right? But government is not doing that. They're saying, give me the money, and then I will take the money to the road project. Now, what Damana is saying, as a guarantee company, all the time for the entire duration of the obligation. If we do that, Amos, I think then pension funds will be able to really go and invest into the economy. So our guarantee is, it's unconditional, it is irrevocable, it is on demand, and it solves the problem that pension funds don't need to do the assessment, because that's what my team does. Pension funds don't need to do the monitoring, that's what my team does, and if any default happens, you get your money back. Our rating is as high as government ratings, so yep, that's what we want to do. Thank you.
Excellent articulated, Chris, around guarantees. And we'll come back to you again to tell us about where these deals are, because, so there's guarantee, right? If that makes the pension funds comfortable, but we're going to discuss and tell us, so where are the deals? Because they're looking for the deals, but they can't find them, the bankable deals. But let's first speak to Oguche. And Oguche, I know, and I'm familiar with what is happening in Nigeria. You are planning to bring together PFAs, the pension fund administrators in Nigeria, to co-invest alongside each other in private equity, in infrastructure, and different alternative investments assets. So can you tell us why it is important for you to bring together these particular trustees and pension funds together? And also maybe you could speak about some of the things that you want to get out of it. Because I know as an individual PFA or pension fund, you can do that on your own, right? But you've thought of going a step further to bring them together. Over to you, Oguche.
Yeah, thanks. So the pension funds can invest on their own, definitely in alternatives, whether infrastructure, like you said, and in Nigeria they do. They actually invest. But we found out that it's better to bring them together under a consortium, as we've seen that Mark mentioned, where in South Africa, the Asset Owners Forum, or in Kenya, KEPFIC. And we thought to sort of follow that model because of a number of reasons. Number one, I think, is the scale. We've seen the scale of the need in Africa and in Nigeria generally in terms of infrastructure is massive, right? And one pension fund doing a small deal here, $1 million, $2 million, is not going to get us where we need to get to. The infrastructure deficits in Africa, and I'll say in Nigeria, is very huge. So we need to do big deals. In order to do big deals, we need to have that pulling effect of people coming together. I think the second reason is because of the expertise is limited. And if we're honest with ourselves, infrastructure as an asset class or alternative assets is fairly new. We've seen that a lot of pension funds pack their funds in government bonds. And for the reasons that Chris mentioned, they're familiar with it, they don't need to do a lot of monitoring. When it comes to alternative investments, some of them need to hire teams or hire specialists. And one of the pension fund MD says, if I'm going to do 3 infrastructure deals in a year or 2 private equity deals in a year, why do I need to hire an analyst specifically for this? So one of the reasons is that it helps you to bring down your costs, because if there's a pooling effect, then you all you determine based on the pool. And I think another thing is it brings down your costs, because if the consortium comes together, there's that co-due diligence, which everybody doesn't have to pay for. Again, one of the pension fund MD says, if I'm doing a due diligence, I'm paying lawyers, I need to pay so much. But if it's shared, then it's better for me. I think another thing, there's a particular quote in investment that says, no one gets fired for investing in government bonds, right? So as an individual pension fund, if I'm investing in government bonds, nothing's going to happen. But if I invest in an infrastructure, private equity, and it goes bust, my board, my trustees are going to come for my neck. But if it's, all of us together, then there's that collective wisdom that comes together. So we pool resources, we sort of debate, we ensure that we get the best. And as Mark has said, there are different models. So we're walking through what model is best for us, whether we co-own the vehicle, whether we come together under a loose structure like syndicated. But the benefits are very clear for investing as a pool entity. In addition, we're able to get people like Damina Infracredit, which does something similar in Nigeria, or other entities like the World Bank and rest, to come together because there's scale. If one pension fund was doing a deal of $1 million, $5 million, it's not going to get World Bank out of bed. But if we come together and say we want to invest in a $100 million project, a rail, road, bridges, then we can attract the DFIs, we can attract the foreign entities who can come, bring their expertise, technical assistance. So I think the benefits are very clear, and we hope to launch that quite soon, and something that we'd like to encourage supervisors across Africa to see how they can midwife or work with the associations to bring to life.
Excellent, Oguche. So Tapologo, maybe coming back to you again. We have had conversations with pension funds, and they are very interested in moving slowly away from government securities. Of course, that's considered safe haven. But I think one of the challenges that they experience, or they do mention that they have experienced, is that fund managers themselves, right, are very comfortable investing in government securities, and they are very much comfortable just earning fees, right, without doing the dirty work of reviewing private equity or infrastructure and so forth. So the question here for you is, what challenges as a fund managers are you experiencing, and what opportunities are you seeing in the market so that you can be able to move the needle forward? Yeah.
It's a good question, and I think it gets to the issues around product innovation and why many funds, well, many managers, should we say, who represent the funds, are reluctant to necessarily go into new products in large scale. And just looking at the product that Chris just described, for example, it sounds like quite a new product within the Kenyan market. If I'm a fund manager sitting on the other side of the table, very often what I'm looking for is, and I must give you context, I'm kind of a traditional asset manager, I'm mostly in the listed space, right? So if you're bringing this product to me, I'm looking at it through a traditional lens and I'm saying, okay, well, what's your track record? What's been the profile of defaults? What is your experience in this thing that you are saying I must allocate client capital to? And so, for example, you talk about a rating, but I mean, in our business, yes, there's only so much weight that we give to ratings. We give a lot more weight to the DD that we do on you, right? And so, in the absence of a historic track record and credit profile of you having actually met your obligation, and remember, you're really going to be tested when there's a default in one of your underlying your guarantors. So, where that track record doesn't exist, then there's typically reluctance to make a particularly big allocation. So that's a structural issue. I did want to touch on this whole government bonds question, though. A lot of the pension systems in Africa, regulation mandates that the pension funds have a certain minimum in government pension funds, and the theory is that they are risk-free and so on and so forth. But this idea of government bonds risk-free is a complete fallacy. So if you're a pensioner sitting in Sri Lanka today and you've seen we saw yesterday in the presentation, you've seen the value of your assets in real terms decline by almost 50%. And there are pension systems on the African continent that have gone through something similar or worse. We must we must get real, right? Government bonds are not risk-free. So then why is it that governments are mandating that pension funds invest such a large proportion of their assets in there? It's because they are funding what government needs to do based on what it said to its constituents, who are the voters, and so on and so forth. So we need to have a real conversation with government to say, okay, we want you to lower this very high minimum that you're saying needs to go into government bonds, but here's our plan for how we can help you fill your funding gap realistically. Until we start to have those kind of conversations, then it's going to stay at the superficial thing around, okay, we've got to reduce government bonds, ignoring the fact that governments have real obligations to the populace. And those obligations are extremely serious. So these type of fora are very useful. And in addition to dealing with the micro issues around how do we help Chris get more acceptance into the traditional main scheme so that he goes from kind of 400 million to 4 billion, because we know that there's capacity for 4 billion. I mean, the infrastructure funding gap in Africa is $90 to $100 billion a year, right? So it's not a question of absence of true demand. It's how do we get past those institutional issues so that when Chris comes to me, and I have a way to allocate a lot of money to him, but we've got to start having, another one, for example, private equity, right? So in developed markets, what private equity is doing a lot of the time is, you have like a small to mid-sized family business, but in developed markets, it's a lot easier for a mid-sized business to have institutional grade bookkeeping, governance, so on and so forth, right? Which makes it then easy for private equity managers to go and take pensioner money and use that to buy into that business. Now in Africa, we've got the challenge of our economies are often very narrow, so you don't have a big base of small to medium-sized businesses that have that institutional grade infrastructure that will allow a PE manager to go in and write a large check to buy that business, right? It just doesn't exist. Why doesn't it exist? Because, our economic structure, so on and so forth. So there's a lot of these structural challenges. But this is why this type of gathering is so important. We've got to start, but I'll just take it a step further and say, we've got to have real conversations on the big issues, right?
Thank you so much, Apologo. And Chris, I can't just help it here because your name has been mentioned several times because looks like the regulations are not the issue, right? Pension funds want to invest, but there are no deals, clearly, right? Can you tell us, where are the deals?
Amos, the deals are actually there, so just to pick on the point that Tapo said, one of the issues that we're facing is acceptance, right? So we're a startup and we're telling them we have 400 million to make you safe. And they're like, but Chris, you've not paid out before. So a couple of things, and gatherings like APSA is very good because then we have the opportunity to keep pushing our message, right? So please keep inviting me. I will be coming. But what we are also doing is we're putting our money where our mouth is. So on some of the transactions I'm going to talk about, I actually get our equity and I'm going to invest it alongside the fund managers, okay? Telling them, I'm putting $50 million worth of my equity into a transaction like this. You know, that is sufficient evidence for you that this is something we will back. Now, my intention is within 6 or 12 months is to sell that position down to demonstrate to the fund managers that, you know, this is a great deal and there's liquidity, okay? Now, where are the deals, Amos? So we are based in Nairobi, but we cover East Africa. So I'm going to tell you the kind of deals we are looking at right now in Kenya. In Kenya, we've got about $200 million of pending bills in the road space, which, you know, is public knowledge. So pension funds are being supported to invest up to $200 million to help pay local contractors that have pending bills. And that we are supporting. We also have a toll road from Mombasa to Nairobi, those that have been to Kenya. It's a big toll road. That's about $1 billion $1 billion that pension funds are going to invest in, and pension funds are going to need our protection because we give them 100% guarantee that that toll road will always pay back for them. If it doesn't, we make the payment. We're also supporting a renewable energy project in Kenya. It's a solar project, which is about $50 million, all in local currency. So those transactions are there. When we go across to Uganda, we have mini grids. So mini grids, if you know the problem in Africa, right? Energy access is our biggest problem in Africa. We have so many people that are not connected to the grid. So that's why African Development Bank has what they call the Mission 300. And pension funds, you need to support this, right? Mission 300 is very simple. How do we get people who are not connected to the grid to have electricity? That's what we're doing in Uganda. We are supporting mini grid companies. These are very small ticket numbers, but the impact is big, right? The impact are your members, right? Supervisors, it's your members that we are solving a problem for. We also have in Tanzania, we have a sugar company that, you know, this sugar company had borrowed so much in dollars, okay? But their receivables are in Tanzania shillings. So we are helping this sugar company refinance, and we will bring in Tanzania shillings from the capital markets to help them have better operations. This should translate to better, you know, better returns for the company, but also for the people of Tanzania. And in Kigali, we are supporting a student accommodation project with one of the big universities. So transactions is not the problem. I think when we go through the first 1 or 2 transactions and I come back for APSA next year, I will have a very big list of this is what pension funds you're doing because this is the right thing you should be doing. Let's grow Africa. This is our time. Thank you.
Thank you so much, Chris. You know, Chris, you have committed yourself that next year you'll be having transactions that we'll be speaking about at the APSA conference, and we are excited about that for next year. But maybe in a minute or two, Sarah, you know, the other conversation that has been had is around, so the market is really keen on moving the needle. We've talked about deals being absent, but Chris has maybe corrected me on that. And Tapolog, of course, has spoken about the need to have deals well structured and so forth. So then can I ask a question to you? Is the regulation the issue in terms of, or can regulations be used to push, you know, the market to invest more? So can we transition from having a minimum limit to, a maximum limit to a minimum limit? Would that work for the industry so that we can push that forward? Sarah, over to you. 1 minute, Sarah.
Thank you. That is a wonderful question, very tricky. Because we have the maximum limit to invest. So the moderator is asking, can it be the minimum? What I can say in that is we leave the minimum limit to the pension fund themselves. according to their appetites and their asset allocation strategies. But they may make sure that they are within the maximum regulatory requirements. That's what I can respond on that. Thank you.
Thanks so much, Sarah. So the onus is on the pension funds themselves to determine their own limitation to that respect. But Mark, I want to come back to you. I know you did a very good presentation, and I think one other thing that is oftenly spoken about, and you can see regulators bouncing the question back to us, and fund managers also bouncing the question around the capacity for the market to be able to invest in alternatives. So I want to hear from you, Mark. What is the World Bank doing to improve, the environment and to make sure that, you're providing technical assistance and so forth, so that at least the market can be able to move the needle as well? Yeah, over to you.
Sure. No, happy to quickly give a point of view. So we do a good bit of capacity building with various pension funds and sometimes supervisors/regulators around the continent, trying to help them as they contemplate some of these different asset classes. Because as I was indicating in the presentation, this requires different levels of skill. We don't often have the chance to do this in front of board members, but that also is a really nice thing that we'd like to add to the work plan, is to give board members the exposure to this as well, to help with their continuing education, because they're a key ingredient in this puzzle. So thank you.
Thank you so much. So this doctor, I would like to open up to the delegates for your questions. Then we'll have another round of questions for the participants. So questions, members? And please say your name, the institution that you come from, and if you prefer anyone from the panel to answer your question, please refer to them.
Thank you very much. My name is Goodson Kapaso. I come from a regulatory authority for pensions and insurance in Zambia. My question is stemming from the submission, I think, from Dr. Sarah, in terms of highlighting the investment guidelines that they do have. We also actually do have investment guidelines. And I think from also Mr. I take the name is correctly pronounced, Shubi, or okay, one of you, the participants there, in terms of trying to raise a concern that sometimes the investment limits may not be in sync with the portfolios you would like to build, and as a result may bring about some distortions. So just to hear you as a panel, whether you think as the APSA or Africa, we should gravitate towards the prudential principles in terms of not having investment limits, but we probably consider having the trustees and the fund managers take the prudential route themselves and act in the best interest of the members without necessarily having the investment limits as is seen in the other markets. And if that is the case, would you then be saying there should be some preconditions that must be met for the industry to move that route? Because we've seen in the past, without investment guidelines, which helps in having diversified portfolios, some trustees or fund managers end up having high concentration, and it increases the risk to the members. So maybe just your comment whether, if we have to move that route, do you think there should be some environmental preconditions to say the market is ready for this kind of regulations I submit.
Yeah, thank you so much. Maybe we could take 2 or 3 more questions.
Okay, another question.
Yeah.
Hand rising here. Lady.
Good morning, everyone. Jane from Kenya. Just a question, probably to APSA members and I suppose to the panel. Are we ready for member choice in terms of investments?
Okay, any other questions? Yes, there's one question at the back.
Thank you. My name is Kadwet Unjoma from Zimbabwe. My question goes to Chris. I was excited when I heard the work that they're doing in an effort to de-risk alternative investments. Are you amenable to sharing the cost of the guarantees? Nothing comes for free. What's the cost?
Yeah, thank you so much. So I'll start with you, Sarah and Okuche. You can discuss this question around the prudential limits, the movement around that. Then, of course, Chris, as we wrap up, because time is not on our side. Then, Chris, you have a question very direct to you. So let me start with you both.
All right. I think with regards to limits, my view is that we should still leave the limits and not allow the pension funds the leeway, because like you said, some of them might be more exposed to one sector. But what I will add is that, the limits should commit to reviewing at least every 2 years, because the market is very dynamic. We've seen the folly of not reviewing in a market like Nigeria, where the last time we reviewed was about 10 years, and that is now being reviewed. But because the markets are very dynamic, things are changing, asset classes are moving. So I think as supervisors is to have that mandatory every 2 years at least to review on an annually basis to check, but also that engagement between supervisors and operators is very important because things are changing. With regards to member decision on where to invest, I think in some markets they do that, maybe in the UK or so. I will say because a number of members are pushing for things like this. So my own personal view will be, perhaps we can give members a percentage, maybe 5% of their retirement savings accounts to be able to determine where or how it's invested. That might help to bridge some of the gap in terms of people wanting to, we can allow them to determine how everything is invested, or perhaps a percentage. That's just a thought I'm throwing out there.
Yeah.
Thanks.
Yeah, Sarah, I don't know, do you have anything else to add in 30 seconds?
Yeah, thank you, moderator. Also, I take the position of our colleague from Nigeria that the limit should stay because taking the history of Tanzania regulatory aspects, prior 2021, the limit wasn't there. So due to the investment decision which were made and excessive risk which were taken, so the decision were taken to put in the limits. And given the fact now there's a chance for waiver to comply with the limit based on the importance of those projects, yeah. I think it's a viable idea for the limit to remain. Thank you.
Okay, Chris, over to you. You have a question on the cost of the guarantees.
Okay, thank you. So, of course, there's nothing that comes for free, but you've got to remember that if we look at a project like the one we're doing in Kenya, right? So the pension funds are going to be earning between 2 to 3% above the government benchmark paper. So that is good for pension funds. Now, for the project developers themselves, we price in such a way that their overall cost of funding is going to be lower than it would have been if they did not have a guarantee. Because in essence, when we give you our guarantee, we are making you look as safe as a government, so you should be getting money at a much lower cost, irrespective of the cost of our guarantee. So everybody wins in this respect, but the actual number is something that we will, it's on a deal basis.
Okay. Then over to you, Tafologo. If you can maybe chime in on the limit as you close, give your final remarks, then we'll have Mohammed in 30 seconds as well.
So I'll take an opposing view to my sister from Tanzania, my brother from Nigeria, they're on the limits. Having lived this experience in Botswana, where for many years there were no investment limits other than an onshore-offshore maximum. So you are permitted to have 70% offshore, minimum 30% in country. how the funds developed in terms of their asset allocation and so on and so forth. They were well diversified, they were professionally managed. Funds applied themselves very responsibly. So I literally saw that occur. And so my expectation is, provided you effectively choose who your trustees are the right way, and you leave it to them, they will do what's right because they'll be held to account by the members. So I would be a proponent for not more limits, but less, and pushing that down to the funds and their trustees.
Thank you so much. Mohamed, your final remarks?
Alors, très brièvement, pour donner un peu l'expérience de la CIMR, je pense que sur ce sujet de limite, l'institutionnel, il doit parler au régulateur. Ça, c'est l'expérience que nous avons vécue en 2017. On a parlé au régulateur qui comprend un peu le contexte national, qui comprend un peu les capacités de l'institution, qui est la CIMR. Et grâce à cette discussion directe, on a pu ramener le ratio de 15% à 25%. Donc on garde toujours une limite, mais on va la rendre une limite un peu plus aérée, enfin, qui nous aide un peu à investir, tout en gardant bien sûr des lignes de contrôle qui sont des ratios d'emprise et qui sont des ratios d'exposition dans le capital qui ne doit pas dépasser 5% par ligne. Donc tout ça, ça fait que cette discussion entre le régulateur et l'institutionnel, elle crée des choses qui sont cohérentes.
Yeah.
Et parce qu'il est là pour l'accompagnement aussi, enfin, principalement, pas que pour le contrôle. Le contrôle est important, mais l'accompagnement, c'est ce dont nous avons besoin le plus. Et c'est une expérience qui est réussie aujourd'hui au Maroc.
Yeah. Thank you so much, panelists, for that conversation. And there you have it, folks. So there are deals. That's what Chris says. Ogucha says that we should consider the pooling route as well in the countries. The regulators in the room say that the regulations are right and okay to move forward. And of course, the fund managers are excited about bankability of projects. So I think we can leave it at that. And thank you so much for listening.
Thank you. Thank you so much for this first panel. Thank you, Guy. Thank you, lady. So let's have a coffee break. Again, a lot of coffee breaks in these 2 days. Okay, a 20 minutes coffee break, and then we come back with the second panel talking about how to increase the pension coverage through micro pension systems experiences. discussion panel of the day and of this meeting. And how announced, we're going to talk about these micro pension models. And first, we're going to, this panel will count 3 panelists. It will last the same duration, but we'll have a 20-minute presentation before the discussion that will be made by Mr. Gautam Bhardwaj. So please welcome Mr. Bhardwaj. He's Director of Pinbox Solutions, come from Singapore. And he will present us the importance and of the components of testing new micro-pension models. So you have 20 minutes. Floor is yours.
Thank you very much. Good morning, ladies and gentlemen. It's a pleasure to be back in this beautiful country. I'd like to thank APSA for inviting me here, and also UK Aid and FST Africa. And I would like to specifically thank Faisal, Mona, and the incredible team at ACAPS for a mind-blowing experience here. It's been such warm and gracious hospitality, and we've had such fun. I really think, I think they've done an incredible job, and they've set the bar really high for the next APSA event that's going to happen. Thank you so much. So what I'm going to do is I'm going to talk about, when I was told to do a presentation, I had thought that I'll do this, I'll also include not only the learnings of things that have worked, but also the mistakes that we have made, in designing pension systems and thinking about innovations in pension inclusion. But unfortunately, when I started making the slides, it turned out to be about 225 slides about just the mistakes that we had made over the years. So I decided to skip that since I have limited time and instead talk a little about what we're doing. But at the outset, I'm very happy to announce that, we've just restarted doing some work, and one of the things that we've done is we've changed our name from Pinbox to Universal Pensions, which we think is perhaps a little more reflective of our mission, though the mission doesn't change, and it's just a new name, but I just thought I should mention that. We are also very privileged to be working with APSA on supporting countries on pension inclusion, and it's a privileged to be working with such a forward-looking organization. We are also working with KMD, and KMD is working in about 26 countries at this point in time on insurance inclusion, and I think, as Ayandev from KMD will explain, there are close linkages between both pensions and insurance, and we are very happy to be working with the KMD team. One of the things that we've done, and the reason I thought I'll show you this, is that we regularly publish books. So this is a book that we had published on the continent with APSA and released it a couple of conferences ago. We're carrying, some of you may not have had got a copy of this book, though it's all available online, but we're carrying about a dozen copies, so if anybody wants, please reach out to Dr. Shem from APSA, and he'll be happy to hand over a copy to you. These are some of the countries. So we currently, Pinbox works in about a dozen countries at this point in time. We are engaged with about a dozen countries on pension inclusion. And a lot of the work that we do is really around assisting either regulators directly, both pension regulators and central banks, or working with governments directly, or with development institutions in thinking more clearly and cleverly about how to include a large population. And the interesting part is that though you see countries from different regions, there is an incredible amount of similarity across these countries. While they're all very unique in their own ways, but the challenges of pension exclusion are almost identical. For instance, in India, you've got about 450 million people who are in the workforce but are not currently saving for their old age, right? And if you see 4 colors on this chart, the orange is really the white is people who are currently old already or are too poor and are going to be unable to save. But there is at least a third of the population which can save for their retirement. And then you have the orange, which is really the future poor elderly. If nothing changes, if we don't really do interventions today to prevent old age poverty, then you'll end up with a very large population. And the segment that is I have a problem with brevity, so it's not surprising. This is normally the first. A crisis and a potential opportunity. And I think the crisis is that if we don't do something, and we've heard this over and over the last 6 years at each APSA conference, that if we don't really get our act together, then we're looking at a very large population of people who will be both old and poor. And this problem is unfortunately somewhat like climate change. You know, it's not very obvious. It's not that every day there is a typhoon or an earthquake or whatever, but it's creeping on us, you know, and it requires, therefore, like climate change, it needs collective, collaborative action. And I think, and it'll take many years to solve the problem. And I think, therefore, it's very similar. And I mean, when I look at Morocco, for instance, the life expectancy at age 60 is almost 22 years. That means I need to be able to save, or I need to have saved enough during my working life to last for almost 25 years in my old age. And I think that's a huge challenge. It's a huge fiscal challenge, and it's a huge social challenge. But if we can get our act together, then I think the upside benefit is very large. And then all things that we heard over the last 2 days on, you know, on investment governance and so on and so forth, start looking, you know, they start making sense, not just for the 10% of the people who are currently saving for old age on the continent, but for, you know, a much larger population of 500 million people who ought to be saving for old age. Now, when we look at, you know, when I look at, let's say, what's happening on pension inclusion or what other countries have done, we think that these are some of the essential building blocks. You need strong political will and policy commitment. You need a legal framework and a regulatory framework which is conducive. You need pension funds and insurers who are looking at new market segments because they realize that there is a saturation in the top, you know, 10% of the population which they have been focused traditionally on. Then you need broad-based digital ID and mobile payments adoption, mass scale use of mobile phones and social media, and therefore digital literacy. You need efficient capital markets, and that's clearly one of the really big challenges. But it's great to see FSD, you know, supporting the continent on creating more vibrant and deeper capital markets to ensure that even modest savings that a farmer or a domestic worker makes today can be converted into a meaningful annuity when they're old. And then you have a very large excluded workforce, and a lot of them have the ability to save. They maybe not save large amounts every month, but they do have the ability to save. And as we've seen, I mean, I was in Albania just last week, and we found that there were a lot of people who have the ability to save. They're saving in real estate, but they're not saving for old age. So clearly there is no, I don't think capacity to save is a challenge, right? And then of course, something that is essential is we have, you know, very trusted community networks. And I think that's especially true for the continent because here, In every country that we've studied, we find that there are SACCOs and cooperatives and microbanks and others who are already dealing with the people that we are trying to cover with pensions. Now, the big question really then is that if everything exists, why are 600 million people not saving for old age? And you know, so, and these are some, I'll just quickly flip through this. I am very conscious of a clock on the left side of the screen here. So these are just some, now this is not an exhaustive list, but at a fundamental level, I think the big question that a country needs to ask itself is, what is the structure of a pension system that will make sense for informal sector workers? And I think there are two models. One is a sort of a vertically integrated model, where you have a country, let's say Nigeria, where you have, say, 20 PFAs or pension funds. Each pension fund sets up their own, you know, everything. They have to do everything. They have to set up their own technology. They have to do their own sales and distribution. They have to do their own, spend money on financial literacy. They have to get a trust. They have to hire a custodian bank. So the entire governance, administrative, and delivery framework, each of these 20 funds has to invest significantly on. Now, the problem is when you invest this kind of money upfront, they find that the tail end of this becoming financially viable is just way too long. So what do pension funds do, or what do these PFAs typically do, is they will say, yes, we are, you know, we believe in pension inclusion, but they will ultimately start focusing on people in this room. So they will only talk to higher income people. So it's like a market. So where each of these shopkeepers has to work very hard to get their customers in, and then each shop has to, you know, have services, they have to hire staff to address questions and so on and so forth, and they're really competing with each other on that front. The second model is like a supermarket model. It's the model that India adopted. It's the model that, say, Rwanda adopted, where they said, okay, let's have a national scheme. Let's have one product and not 20 products. When a person opens an account in Rwanda, he opens an Ejoheza account. And that person will then just simply have the ability to decide which of these 20 funds should manage my money, you know, if that is required. Or you can have a default, or you can have a life cycle option. You can have many things. But a lot of the expenses that each of those shopkeepers we saw in the previous slide, you know, could be avoided by sharing some of the infrastructure costs. And so you could do, let's say, administration could be centralized. You could do sales and distribution could be centralized. You know, financial literacy could be centralized. So things where people are spending a lot of money on could be centralized and shared. And once you start sharing those costs, then micropensions becomes more affordable financially viable for the industry and more affordable for individuals. And I think this is an important issue. You know, the population that we're dealing with, and mind you, please note that this young man here, who's probably a future micropension customer, doesn't have a mobile phone. He's using a slipper in his hand. But this is the level of aspiration that we're dealing with. And I think it's incumbent upon us to ensure that we are able to convert this aspiration into a reality, right? Unfortunately, what ends up happening is that when you're young, retirement looks just too far away. And when you're my age, and if you've not yet saved for old age, then, you know, and I now realize, unfortunately, after many years, that I should have saved enough. Now that I've not saved enough, my only option is to aggressively start smoking so that I don't outlive my savings, right? The second thing that we've learned is that before you embark on some reform or start doing something, try and do some assessment to look at any past efforts that you've made and also inform, let's say, the design of a more inclusive and a fit-for-purpose model. In many, many countries which have not succeeded, I find that they've taken what already exists for formal sector workers and said, okay, how do we retrofit this for informal workers? And I think that's perhaps the wrong way to look at it. I think we should look at things from a demand-side perspective, and countries that have done that have actually succeeded well. The second, which again is critical, and I think Rwanda and India again were sort of pioneers in this. They realized that if I'm the secretary in the Ministry of Finance, I have tons of other obligations and priorities. Or if I'm the chairman of the regulatory body, I have many, many priorities. You know, it's not just simply saying how do we extend coverage. So you need a dedicated team of, say, 10 people who jump out of bed every morning with just one objective. How do I get the next million people to start saving regularly and adequately for their retirement? How do I coordinate with different kinds of stakeholders to make this happen? So there's a key role for a mission office. The third learning is that in many countries, as we saw a few slides ago, that the ecosystem seems to already exist. And I think today, more than ever before, it's possible to use technology to sort of leverage the existing ecosystem and architecture to create what I would call a micro-pension marketplace. Imagine an Amazon kind of a system, where anybody can access a centralized platform to buy a small ticket pension or insurance product, effortlessly use her mobile wallet to send money directly into a pension account, and see her statement and so on and so forth. This can create universal access, and this can actually make sure that you are able to democratize savings. And interestingly, if you did this, and if you used existing ecosystems and didn't need to build new institutions, you can actually launch this on an operating cost basis. So if there's let's say a mobile operator, he doesn't care whether you're sending money to your brother-in-law or to your pension fund. So the transaction cost will not be more. A fund manager, which has already got the capacity to manage money, is not going to spend more on managing more aggregated savings that you are giving him from micro-pensions, right? The third, I think this is, I don't know, I've forgotten the count, but whatever. Another important point is alignment of incentives. Now, all of us work on incentives or disincentives, right? So, and incentives, we feel alignment of incentives and communicating the alignment of incentives is critical. So if you look at micro-pensions, then what we are really saying is that we want, let's say in Uganda, we want 10 million people to start saving for old age. So the government is clearly interested in doing this. They want as many people to save, and they want as many people to save as much as they can so that they are non-poor in their old age. The product partners, whether you're a fund manager or an insurer, has an identical incentive. They want to manage as much money as possible, and so therefore their incentives are completely aligned with pension inclusion. If I'm a payment solutions company, if I'm, say, M-Pesa or whoever, I have a lot of interest in this, in micro-pension succeeding, because now I'm getting suddenly a large base of people who are going to start transacting on their mobile wallets month after month or day after day, year after year for the next 30 years. And therefore, this is very clearly aligned with payments inclusion. So aggregators like, say, SACCOs or distributors, they have the same incentives. They want as many of their current customers to start saving for old age because they'll start getting transaction fees. And subscribers clearly have the same incentive, which is they want to be able to be non-poor and make sure they don't have to outlive their savings or start smoking when they're 60. The next thing I think which is important is we need to be flexible, because people have very different incomes, they have very different demographies. The informal workforce is incredibly heterogeneous. And I think it is possible to create a national program which can actually be flexible enough to be fully customized for every individual. And I think we've seen that happening in a couple of countries. But I think that flexibility needs to come in the way we think about this. Fiscal incentive, I mean, in every country this topic comes up, that we need fiscal incentives to jumpstart voluntary coverage. India did that, Rwanda did that. When India did that, we got I think in 2-3 years, we got about 4.5 million people to join. But then the key question was, why 4.5 million? Why not 400 million? What went wrong was it an incentive design issue, or was it an incentive communication issue? What was the problem? So, and I think there is much more that we can do. And I think in that context, there is some work that we're doing with the Collar Pension Institute in designing, better incentives for developing countries. And I think David, who's here on the panel, will talk a little more about this. Now, okay, now I have only 28 seconds left. So one important thing is, why don't, the big question that every time comes up is, people don't, informal workers don't have money, and I think the big question then is, why is it they seem to have some savings, but why is it that they never are able to afford to save for retirement? And I think the main question that we find is lack of insurance. So what happens is, if I'm a farmer or if I'm an Uber driver and I have an accident, or my cow dies, or my crop fails, or my daughter is unwell, for all of these risks, I end up using past savings to fund my retirement, to fund the cost of the risk. Now, if that past savings are not enough, I end up going and borrowing expensive, taking an expensive emergency loan. Now, what ends up happening with this is two things. One, I've exhausted previous savings. Two, I've mortgaged my future surplus income in favor of repaying an expensive loan. And the third is that when Gautam then goes to that farmer and says, listen, you should save for old age, the answer that I get is, yes, you're right, but I can't, lock my savings in till age 60, because what if my daughter is unwell or my cow dies? And I think that's an important issue. So we need to layer emergency savings. I think Zarina is already doing that in South Africa, where we've got a two-pot system now, and some other countries are experimenting with that.
And we need to conclude.
Okay, fine. I'll be very, very quick. Just maybe 2 minutes?
Yep, good.
Thank you so much. The next is that while, it makes a lot of sense to target by occupations. Now, if you launch a micro-pension scheme and say, pensions for informal workers, I assure you nobody will sign up. People don't see themselves as informal workers. But if you say, pensions for teachers, suddenly the teachers will sit up and say, oh, this seems interesting. I mean, what is this for us? So, similarly, if you said social protection for farmers, the farmers will sit up and say, okay, what is this for us? So I think it's useful to target people by occupations or even demographies. So pensions for women could resonate very well with women, right? But the problem is that people are not the same over a 30, 40-year horizon, right? So an Uber driver today will not be driving an Uber for the next 40 years. He might become a farmer, he could set up a shop or whatever. So we need to make sure that we design for portability. The next is simplicity, and I think this is something that we've done. Here in Morocco, 80% of the population uses WhatsApp. So if I really think about it, today if we announced a new micro-pension program where people could use their WhatsApp to set up a micro-pension account linked to the national ID here in Morocco, the good thing will be that you will end up with 80% of the population sitting with an app that you don't have to teach them how to use or force them to download or anything. And they'll be able to use it in Arabic or French or whatever language makes sense to them. And I think that's a big win. So let's create the interface which is intuitive and simple. Okay. So the next lesson was really that I think credibility and trust is a very big issue. So when I go and meet people in India, for instance, and I say Franklin Templeton will manage your money, the question is not really about retirement. The question is, who the hell is Franklin Templeton? We end up spending most of our time explaining Franklin Templeton. So I think the important thing here should be, can we have a situation where we deal with, or we work with trusted field partners and let them become the face? So if I've been working with a microfinance institution or a SACCO or a cooperative for the last 10 years, when they talk to me about this, it will resonate more. I won't explain this is a little complex, but the last thing is really we should pilot test rigorously. And so test on a small scale, you will always make mistakes. I told you I had 225 slides on mistakes. So you will always make mistakes, but start small, test it well before you do a national launch. But the more important thing is continuously monitor what's actually happening in terms of efforts, outcomes, and gaps. Can I just do a 1-minute story of this goat? It's a pension goat, so it's quite relevant.
Okay.
Oh, you're very kind. So, the thing is that if we can actually do some of these things well, then you'll end up with good outcomes. Now, this is a pension goat. Now, how it happened was we had this woman in south of India who started saving regularly and was also inflation indexing her savings. So we went and met her and we said, Saira Bano, why, this is wonderful. We see that you're saving a lot every year. And not only that, every year you are indexing your savings. So how do you manage to, put aside the money to save for retirement? She says, well, Gautam, I have a goat farm and I nominate a pension goat every year. And then when it's Eid, I go to the market and I sell the goat in the market. And whatever money I get from the goat, I put it into my pension account. I said, this is fantastic. I said, but how did you inflation index your savings? She says, well, I didn't do that. It's really the goat, because when I sold the goat last year, it was 12,000 rupees. And next year, when I sell the goat, it'll be 15,000 rupees. So there is an indexation which is built in. Now, what I'm saying is, if we can actually do this well, you will end up with being pleasantly surprised and with completely counterintuitive outcomes. We never encourage people to save using goats, but that's how people adopted this. I thank you for your patience, and thank you for your patience.
Thank you so much, Gautam, for this very, very, very interesting presentation. And then we're gonna talk about this micropension importance in system with Parul Seth Khanna. So please, who will be the moderator. So Mrs. please welcome her. And she will discuss about this topic with Mr. Ayendev Shah, who is General Manager of KM Daster and Company from UK, Dr. David Pincus, Director of Color Pensions Institute, and Mr. Benjamin Mukibi, Chief Manager Research and Strategy of Uganda Retirement Regulatory Authority from Uganda.
Thank you so much. Thank you for the introduction. I also wanted to introduce and welcome Dr. Shem, who's the head of the secretariat at APSA, and Gautam Bhardwaj, if you can please join us back on the stage. On the onset, I'd like to thank you very much. On the onset, I'd like to thank APSA, ACAPS, FST, Africa, and UK Aid for bringing us this spectacular event in the beautiful country of Morocco. So thank you so much. I think I'm going to dive straight into the topic on a very timely topic of pension inclusion, micro-pensions, with examples from Asia and Africa. I think there's a lot that is done on the pension market for the private sector, and they've made progress with leaps and bounds. But I think the question here is for the 90% of the informal workforce across Asia, Africa, and Latin America who work for themselves. As we speak here, about 600 million of the working force of the 1.2 billion currently live on this continent of Africa. So what is it that can be done today? And I don't know if it is really while there is a question of what individuals need to do, but I think there's also this aspect of the macroeconomics of it. Because without long-term savings, I'm not sure whether the infrastructure costs or economic sovereignty or any of those can be met without robust long-term savings. And this is a leaf that I'd also picked up from my dear friend, Mr. William Price. So thank you, Will. I'm going to start straight with the questions. And I think, David, I'm going to sort of point the first one to you. While we are sitting here, what do really the demographics look like, and what is it that we're really looking into in the future?
Thank you very much, Parul. And please let me first take a moment to thank the organizers of the conference and everyone that has worked to make this event happen. I've learned an incredible amount over the past 2 days. Now I look forward to bringing you some of my opinions and insights. So for me, well-designed funded pension systems would allow to address two important structural trends and challenges simultaneously. The first one you've already mentioned is demographics. Africa is aging. It is still young, but it is aging, and also quite fast if you look at international comparisons. In the next 25 years, the share of the population aged 50 years and more on the continent as a whole will increase by almost 50%, and the median age is projected to increase from 19 years to 25 years. So this is quite fast aging. And because of demographics, I think it's very important to set up sustainable and well-designed pension systems now, while the populations are still growing and the demographics are still on the side of policymakers, because it is easier to make transitions, and the transition is cheaper to new forms of pension systems when you still have the demographics on your side. The second big structural challenge is something we've already heard quite a bit over the past 2 days, and that is capital market, limited capital market development. If you look around the world, the countries with vibrant investment environments and big capital markets very often also have big funded pension systems. So we've already heard Australia, Canada, the US, they have assets, pension assets to GDP close to 150%. And the world leader in the statistics is Denmark with over 200% pension assets to GDP. These correlations between size of the pension system and size of capital markets, I think, show that under certain conditions, funded pension systems can be an important pillar for capital market development and also, therefore, long-term economic growth that is driven by local factors. And there are also recent papers from the World Bank, for example, that show that pension reforms towards mandatory funded pensions, in that instance, increase issuance of local bonds and local shares after approximately 4 years. So to conclude, designing good pension systems is about much more than old age income. They can also help set countries on paths of sustainable long-term growth.
Thank you for setting that context, and I think setting up pension systems also requires a rigor, and a lot actually is also got to do with the regulatory environment, and that actually gets me to Dr. Shem. Before I come to you, Benjamin, as a regulator and practitioner. Dr. Shem, what kind of conviction are you seeing with the members of the APSA who are looking to implement micropensions? What is it, do you think, are the limitations? Are there any, or the rigor that they want to do it with? And any examples that you could set out, please?
Thank you very much, Parul, for that question. I think we needed to note at the very onset that over the previous annual conferences of APSA, we've been discussing this topic of coverage because it is really critical for the pension sector in the continent. Because all the discussions we've had since yesterday have been about just about 10% of our population, because that's the reality. Those are the people who are saving. So those are the funds we want to mobilize to develop the capital markets, to invest in infrastructure, private equity, and even lend to government. 80% of the population is not with us. And that's why this topic of pension coverage is really critical, and we keep on thinking about it. In the first presentation, I think, of the conference, you realized that only 9.6% of our workers are covered. So 9 out of 10 are not, and we must do something about it. The beauty is that our regulatory authorities, our supervisors, most of them have a dual mandate to supervise and to regulate and to develop. I think they have excelled in supervision, but I think the judgment is still out on development, because this majority of workers are not saving for retirement. And if you're not going to do anything about it, that it means, as the line of last defense for people who are working and retiring, we are sending them into old age destitution, poverty. So we really must do something. So I think Gautam's presentation has highlighted the challenges that we have, and it's common across countries. And therefore, we must be able to innovate and design savings schemes that can be able to mobilize these savings. I think although the workers are heterogeneous, as Gautam has said, I think we can come up with schemes that enable them to save for retirement. And so we must innovate. And I think the building blocks, as you've seen, expounded on by Gautam, They are there. So why are we not going the extra mile to do that? And I think the answer lies in technology. The mobile phone penetration is great in the continent. And if you rely on financial access surveys and FinCorp surveys being done across the continent, access to financial services has tremendously increased. But that has not happened for pensions. It means we have work on our hands and we need to innovate. So we need to adopt that simple technology, ensure that members can be able to communicate with the pension schemes that suit their circumstances. Their incomes are intermittent, employment is seasonal, and they change jobs frequently. So we need to accommodate those kind of characteristics in the schemes that we design for them. The schemes that we have now and we supervise very vigorously are really meant for formal sector workers, people with predetermined incomes every month and with predetermined savings every month, so they can afford to be very regular. That is not the case for this large informal labor market that we talk about in the continent, almost an average of 85% in each country. And so that is the challenge that we have, and I think we have our work cut out for ourselves. Thank you.
Thank you, Dr. Shem. I think you bring up a very important point because I think we need to shorten the gap between intention and action. And while the problems may be, sort of resonate equally amongst all the countries in the developing world, but I think the solutions will still need to be customized. And that would bring me to you, Benjamin. I believe you have come with a blueprint from where you were a few years ago, maybe 4 to 5 years ago, to where you are now. I think the audience would love to hear your experience of how you actually reached here in terms of changes, resolutions, learnings, and new innovation that probably Uganda is at the cusp of.
It's fine. Okay, thank you so much, Parol, and distinguished guests of the APSA. The experience in Uganda has been a roller coaster experience because at the beginning, that is about 6 years ago, or more often than not, we're discussing coverage, just looking at it from the point of view of enrollment, citizen participation. And never did we ask the question about what is it that we want to achieve. When we say Africa, it's just 10% coverage, what do we mean by coverage? So we had a very big challenge to explain to our board and also to the supervisors, the Ministry of Finance, what we mean by coverage. Because just merely saying that you have only 10% is not convincing enough. Now, Okay, so I'll continue. All right. Thank you. Thank you. Yes, very well. So with the two schemes that we piloted demonstrated, number one, that poor people will not save on their own. So we must find a way to rope them in, to encourage them and require them to save. Because we see from the micro-pension schemes that there was no momentum. People enroll but do not remain active. So what is it we can do to make sure that those who elect to be part of a micro-pension scheme continue to be active for the long term? There are also issues with regard to costs, the costs of marketing, technology, the transactioning using the MNOs. All those are constraints that you face. So we realize that it cannot be a commercial project. It must have components of a social purpose project, because you cannot expect the private sector, like insurance companies and others, to engineer this effort. Because right now we have so many insurance companies that have individual plans, but they cannot get to the clients that we're looking at, because they're doing a business and they're looking at how much they're putting in. So the biggest lesson is that it must be government-led. For the client groups that we're looking at, it must be government-led. And the next is technology, because technology helps us to sidestep the bureaucracy that we have in our countries, where you really need to bother about the KYC, then you need to go and meet the people where they are. So technology helps us to do that, and now with most of our countries having these national IDs and using technology to transact using the mobile phones, it becomes easier. So the first lesson is it must be government-driven, government-led, technology-driven. So using technology as a delivery channel leads us to all these ecosystem partners, the MNOs, and also grafting onto already existing institutions, because we call them informal sector workers, but they're organized. Most of them have groups, and they can be reached in their groups as points of presence to make sure that we drive this agenda. Now, on the question of who has to do it, when we say government, what do we mean? Because over the last 20 years, we have been attending meetings and we talk about coverage, that we need to do something about it. And part of the discussion as we began was, why is it that we are not moving? So in Uganda, we undertook studies to respond to some of the challenges. Challenges like who has to do it. We realized that the regulator on its own could not push this agenda, so we decided to involve other stakeholders, including the Ministry of Finance, the Ministry of Gender, and other actors, the National ID Authority, and all these, including the private sector, the MNOs, the Communications Commission, because all these ecosystem partners are central to what we want to do. So we started bold discussions about what we want to do, and our studies were shared with them. With the support of the World Bank and FSD, we're able to understand that this is an effort that no stakeholder can do on their own. So working together with them, we're able now to do a feasibility, a detailed feasibility, where we know, for instance, that for sure, the people we call informal sector workers, the way they're transactioning, for instance, if you look at their transactions on the mobile phones, what are they paying for, how much are they paying over the years, you see clearly that $1 a day is no longer an issue. There's a cohort of those Ugandans that can actually make nominal contributions and then have something in the future. So the question now in the feasibility was, when we talk about saving for retirement, what do we mean? What is the lock-in period? Because right now people are saving for 1 year, they're saving for 6 months. We need to make sure that we do it for the long term. But there's so many immediate and near future needs. So it said, well, in the feasibility, we must have a basket of goods, a product basket that goes beyond just saving for retirement, but you have a proportion. You say, okay, if it's 100, 60% goes to matters relating to saving for longer, for retirement, and then you have the balance to deal with immediate and near future needs, and these ones must come with proof of purpose. I say this because there's so many reasons why you can access this money. So proof of purpose means that it must be welfare enhancing, because at the end of the day, there are so many other ways these people are saving, but we must engineer an effort that includes insurance, it includes pensions, and also those aspects that we believe are enhancing of what we want to achieve in the long term. So we answered the question of the objective, that we know we are saving for so many things, and it's not merely abstinence from consumption out of disposable income. It's for a purpose, and it's the purpose to ensure that Africans don't live longer poorer. So if they're in old age, we must address the old age income security challenge. And that's what coverage is about. Let them be enrolled, let the money be invested prudently, let's encourage them and require them through the incentives frameworks that have been proposed. And right now, we are ready. We have understood what we need to do, but the most important thing is to make sure that all the actors must be involved and agree that this is something you want to do as a country. And in this room, we must agree that it's something that we must do as a continent because it's an urgent and strategic priority. Thank you.
Thank you so much, Benjamin. That is, I think, hugely valuable and insightful. And I think you also make a very important point on bundling of products to make them like a life cycle approach that makes the informal sector reach their goals while they still look at long-term savings, and also deciding, sort of identifying the ones who are able to save in this very heterogeneous group of people, as Gautam and Dr. Shem also said, because there will be dissavers for life, but there will be those who have the capabilities but don't know the avenues or the trust of where they can save. Ayandev, I would like to turn to you because this is, Benjamin brings out the insurance bit in it. So how do you think it is really important to sort of bundle insurance with pensions, and especially in terms of climate and pensions?
No, thanks, Parul. And just to start with, so sometimes we think insurance is beneficial to a pension scheme. I think it is not only beneficial, it is the most important thing, especially when we are talking, Parul, about the micro pension schemes. And somewhere you touched base upon, and where even Gautam was mentioning in the presentation, who these people are. They are informal sector people. You mentioned about heterogeneity. Yes, and also if we look at their nature of the job, they migrate not only across employers, across jobs, across sectors, but even across locations. Now imagine in this room, if we leave or if we start living their life where we don't know where our job tomorrow is, where we don't know in which city we will be tomorrow, and we also don't know what our income is. So today, suppose we are earning $10 a day, tomorrow I don't know whether I can earn $10. So there's a high level of volatility in
So with everything put in place, still, apart from the fact that people are not registering, about 99% of the accounts are not funded as at now. So what are we going to do to ensure that these accounts are funded? It is true, like somebody once said, that micro pension plan is a hard sell where there are no incentives. I think Gatam said so sometimes back. That it's difficult to market micro pension plan where there is no incentive. Now, given the economic condition of Nigeria and the chorus of the federal government always is there is no money. So getting money out of the federal government in Nigeria has been practically difficult because of the economic situation. And we have been talking to development partners and international foundations to assist. We have not secured any assistance per se as at now. So how do we get them to fund this account? They have opened the accounts, but the accounts are not funded. So what do we do as a commission? In addition to provision of incentives, what other things should we put in place to ensure that these accounts are funded? Given a lot of things that we have done to make that plan easy for the targeted market. Thank you.
Thank you. I think, Gautam, I'd like to take that question really quickly, please, because we have more questions in the room. Yes, ma'am, we'll come to you. Gautam, can you just take this question really quickly, please? Like in 30 seconds, please.
Dr. Malande, I think what I would say is that the glass in your case is, it's not half empty. I think it's half full. You do have, while you don't have 200,000 regular savers, or actually you don't have 20 million regular savers, so, but you still have those 8, 10, 12,000 people who've been saving regularly. And I think the key question then is to actually go out and find out what went right. So what did you do with those 12,000, which has prompted them to save regularly, and what has prevented the people who, the balance, whatever, 190,000, why are they not saving regularly? Why did they open an account? Who spoke to them? Why did they drop out? Why did they stop contributing? Or why are they intermittently contributing? And I think the answer really is in doing a more scientific diagnostic and actually going out and sitting with those people. Because without that, we just don't know what we don't know. So, and I think that's perhaps going to be the first step. If I was Nigeria, the first thing that I would do is go and meet the 190, and I would go and meet the 10,000. And try and understand what's working and what's not.
Thank you.
I think that'll inform your next thing.
Thank you, Gautam. I think also the panel has APSA and people who are looking at co-contributions, insurances, and Benjamin also brought out the importance of feasibility study to figure out where you are as is. Yes, ma'am, one more question at the back, please. Just the last question, I guess, please. And I'll take just a...
Yes. Thank you.
The lady at the back, please, in the red.
Thank you. I'm John Mugabo from Central Bank of Rwanda. Central Bank of Rwanda is the regulator of financial institutions, including insurance and pension. Thanks to the presenter and panelists. As Dr. Shem said, that we used to say or to sing one song of raw coverage at all times we meet as APSA or at any other platform. In our country, we used to sing such a song, or we used to say such a say, as I may say. But of course, based on the good governance, political will of all pension stakeholders, we shifted from the intention to the action. So here I mean, by 2019, the government of Rwanda established the Ejo Heza, as you have seen, that has been spotted there on the PowerPoint presentation. They established the Ejo Heza, a micro pension scheme. Good enough, based on the pension coverage we used to have, it was around 10%, like any other of the African or countries. However, we've shifted from the 10% to around 40%. From, you can imagine, from 2019 to date. and it has registered exponential increment given the membership. But given that 40% is not enough that we can be jubilating to, we are now, as a country, we are now proposing to have the EJO-HESA, that micro pension, phase 2. It means that it's going to be upgraded based on the needs of the members. Here, I will be quoting the presenters, saying that given the initiatives, so as a country, we saw that the initiatives that were provided by them, they are not good enough to satisfy the needs of the members. So it's now going to be upgraded. So given to the assignment as we can be given to the other APSA members, in order to minimize this saying of raw coverage, can it be the assignment of everyone here in the room that when the next time we meet in Ghana or in another country, what have I really done as a prayer? Because we are good at drafting the motivational or the concept paper, can we at least go and draft such motivational paper or conceptual paper, and we address to where it's supposed to be addressed, such that when we meet next time in the host country, that will be at least done on our role. Thank you.
Thank you.
And then,
go ahead, please.
yeah, no. And then for the comfort of our colleague from Nigeria, I think, that has been facing the challenge of the people that in micro pension subscribing but not yet paying the contribution. If I may go quick, in our country we have the saying that come and see, go and tell, or come and see, go and implement. Honestly, we have the micro pension that is fully operation, and it can disclose all the challenges and opportunities such that you can borrow from that. Our colleague from Nigeria, you are welcome in Rwanda to learn, to see and learn and implement. Thank you.
Oh, thank you so much, John. That's fantastic. Dr. Shem, would you like to share the vision of APSA on this, please?
Thank you, Parul, for giving me the last word on this. I think it's clear that the demand for increasing pension coverage is real on the continent. And what we see is dotted experiments from each pension jurisdiction to the next. Sometimes we see successes, like is the case in Rwanda with the Ejozera. Sometimes we see marking setbacks, like is in the case of Nigeria. The beauty is that APSA wants to get all this knowledge together so that we can do a peer-to-peer learning exercise. What worked in Rwanda and why? What didn't work in Nigeria and why? And we pick lessons as we go along. Just for information for the meeting here is this journey actually probably was, the micro-pension journey started in Kenya with the Mbao pension plan in 2011. Same parameters. Ejoza came much later. They learned lessons from Mbao. And you know, sometimes you learn from a teacher and you become better than the teacher. And that is what happened. So I think the devil is still out there, but we need to understand, we need to study EJO-HERA and the way it has performed. I know there were incentives that were inbuilt. There's a micro-insurance product, there's a micro-credit product, there's a last respect product in it. Those were all absent in the Nigerian case. And all of them are not perpetual. So we needed to understand that when we put those incentives and take them off, whether we are able to sustain the membership and effective participation in that pension scheme. Are people still contributing and going further? We hope to get that study done so that we can probably advise Nigeria better for their case. Thank you.
Thank you so much. I'm going to conclude quite quickly, and I think this forum has been, and this discussion has been more action-oriented than exploratory and thinking of the concept. But gentleman to my right did not mention anything about women and gender on the pension discussion, so I'm going to take that leverage to do so. I think countries need to design and implement on products that are also focused and gender inclusive. We women are better savers, ladies. We live longer than men. We have income interruptions due to childbirth, family responsibilities. And I think nations, countries, including every individual in this room, needs to get on the drawing board to also design solutions that are women-oriented. So I think I would like to conclude with making pension inclusion, micro-pensions, whatever word that you want to use, but we have to make them personal, portable, and possible. Thank you very much, ladies and gentlemen, for your time.
Thank you.
And thank you, the panel.
Thank you so much. Better savings? Better savings? Okay. I got 3 sisters and 3 daughters. They don't save anything. Thank you so much. All right, so before we move to the conclusion speeches with the communique and the closing remarks and vote of thanks, I would please ask you to welcome Ms. Anne-Marie Dalton. She's Secretary to the Asset Owners Forum of South Africa for a 2-minute submission. Please, go ahead.
Thank you. Thank you so much. And I also just want to congratulate all the organizers for a fantastic conference and all the engagements that we are having. And thank you for allowing me just this 2 minutes to talk about something that is happening on this continent. It will not come our way very soon after, and that is the hosting of the G20. And the hosting of the G20 and its business arm B20 brings a lot of opportunity to this continent, but we need to mobilize, we need to come together, because a very big question that was raised was, what do we have to offer other G20 countries if they want to invest in infrastructure and private markets within the continent? And one of the streams or the workforce streams in the B20, where we now, for the first time ever, have retirement fund representation through the Asset Owners Forum, you know, we have an opportunity to mobilize. And one of the themes that is there is how to deal with blended finance and public-private partnerships, and how do we structure that so that we can invest in infrastructure, real assets, and obviously alternatives. So what we would like to do, it's almost like a call for action, as the Asset Owners Forum, is to ask whether, you know, there is appetite for us to come together, to mobilize, to have conversations about the recommendations of the B20, to maybe also develop positions papers, whether it is a, you know, a collective position paper, because we know that countries are different. We know we have different responses, most probably. But at least that there is a centralized forum where we can create these responses. And my request and my submission is then to ask whether we can then use this platform to do that call and that expression of interest, and then arrange for a meeting with the regulators, first and foremost, I assume, and then thereafter with the asset allocators, who will most probably have to bring the capital to these projects and solutions and recommendations that B20 will come up with. So thank you very much for that, and if that is the case, we will then take the next steps to communicate how, where, and when these gatherings will happen. Thank you so much.
Thank you, Anne-Marie, for this submission. Now, let's welcome Dr. Shem Uma, Head of Secretariat of APSA, for the reading of the conference communique. Okay, Dr. Shem Ume is coming. Applause again. He's ready.
Thank you. Thank you, ladies and gentlemen. Whatever has a beginning has an end, and we have picked very key lessons from the 6th APSA conference, and we have written a short communique about the same. And let me just read it the way we have crafted it. So, distinguished ladies and gentlemen, the distinguished delegates from Africa and around the world gathered at the 6th Annual Africa Pension Supervisors Association Conference in Marrakesh, Morocco on July 11, 2025, recognizing the inherent diversity of pension landscape across Africa with various system designs tailored to each nation's unique demographics and economic realities, acknowledging the profound impact of the fundamental distinction of the structure, funding mechanisms, and long-term sustainability of pension provisions continent-wide, remaining acutely aware of transformative emergence of innovative technologies and the growing imperative of the environmental, social, governance considerations in fund management and investment, which demand a fundamental rethinking of existing pension designs, cognizant of the persistent challenges confronting pension systems, including critically low coverage, particularly among the women, pervasive governance issues, capacity implementations, longevity risk, escalating cyber insecurity, currently inadequate but growing assets under management, restrictive regulatory frameworks, and significant macroeconomic and demographic shifts, and understanding a comprehensive grasp of pension reforms, challenges, opportunities, and the evolving investment landscape is paramount for building resilient and inclusive pension systems. And building upon the insightful presentations, robust discussions, and thought-provoking contributions throughout this conference, we hereby recommend for urgent consideration by pension policymakers, regulators, and industry players the following. Number one, that we need to strengthen existing legal and regulatory frameworks to ensure efficient and transparent operation of pension systems effectively address the challenges of old age poverty and also for bolstering the efficiency of Africa's financial markets and supporting overall economic growth. That we need to fully adopt risk-based supervision to promote the stability and integrity of pension systems to significantly enhance the ability of supervisors to proactively identify, assess, and respond to a broad range of risks, thereby permitting a more comprehensive understanding of emerging risks across the region. Furthermore, extend to the application of risk scoring methodologies to service providers, ensuring a holistic oversight of the entire industry ecosystem. And broaden and deepen collaboration with the private sector and development partners to improve citizen participation in funded pension schemes and ensure the long-term financial sustainability of such schemes across the continent. And fourth, to develop and implement a forward-thinking risk management and inflation hedging to ensure that retirement funds maintain their real value and adapt robustly to evolving market risks, safeguarding the purchasing power of retirees. And number five, to integrate
responsible and sustainable investments by developing appropriate tools and guidance and actively integrating environmental, social, governance factors into investment strategies and decisions, establishing robust oversight mechanisms for ESG risks, and aligning them with global best practices in sustainable finance. And number 6, to champion the development of an Africa-specific sustainable finance taxonomy for the financial sector in Africa, developed through Africa's unique lenses and context. This taxonomy should be accompanied by the establishment of a comprehensive ESG information hub to provide critical data and insights, thereby informing and facilitating ESG-compliant investments across the continent. And number 7, to enhance cross-border portability of retirement benefits with no or minimal loss as acknowledgement of the high labor mobility across the African borders. We particularly didn't discuss this in detail. We shall make it a topic in our next conference. And number 8, encourage investment in alternative investment assets that are secure and give long-term value to members by exploring guarantees to de-risk the alternative investments. And lastly, number 9, champion inclusion of informal sector workers into saving for retirement by including requisite policy and legal framework, digital identification system, sustainable incentives, and innovation frameworks. That is our communique out of the conference. Thank you very much.
Thank you, Dr. Shamuma. Thank you so much. And now let's move to the closing remarks, and please welcome Ms. Zarina Kamrudian.
So, moderator, when I still have the floor, allow me to make 2 announcements.
Okay, go ahead.
2 brief announcements. I have copies of the book that we collectively did with the universal pensions. I have only 10 copies. I want to distribute them on a first-come basis, first-come, first-served basis. And number 2 is that all presentations that have been made during this conference will be available on our website from Monday. If you urgently need them, we can share them with you via email. Thank you very much.
Thank you. Zarina, the floor is yours.
Ladies and gentlemen, good afternoon. As the 6th APSA conference draws to a close, I wish to extend my heartfelt gratitude to all of those who have made this event a monumental success. Let me start by thanking our host, ACAPS Morocco, for the spectacular organization of this event and for your hospitality. It has been incredible. The past few days and even last night showcased Marrakesh, Morocco in all its glory. From the Berber and Marrakesh dancers and singers to the fire performers and the stunning setting, the delicious food, and not to mention the lighting up of the sign of APSA 2025. It was simply amazing. The only concern that I must express is that now I hope that the host of the 7th APSA annual conference won't be feeling too much pressure. A special thank you to you, Mr. Shafai, the chairperson of ACAPS, for setting the tone for this conference in your opening remarks, both at the workshop, the APSA IOPS workshop, as well as the conference. Your expression of the importance of solidarity across the continent to ensure financial inclusion, a dignified retirement for all workers, and economic transformation resonates deeply with all of us. Thank you for giving so generously of your time to attend and contribute so meaningfully to this event. I would also like to thank Siham, Ramli, Muna Chentofi, Faisal Moudin of ACAPS, and the rest of the team responsible for the organization of this brilliant event. Thank you for your hard work. If I may take this opportunity to please call you to come forward to the stage so that I think the proper appreciation can be shown. If you would please come to the floor, the ACAPS team.
L'équipe ACAPS. Shafei, Mouna, Siam, Faisal.
So if we could please give them a warm round of applause. I think this was a brilliantly organized event. Thank you kindly. Then, to our sponsor, FSD Africa, thank you for your continued and valuable support and for your valuable interventions at this conference. Thank you very much, Mrs. Mary Ngujana and Mr. Amos Mugi. Could we please give our sponsors a warm round of applause? Thank you so incredibly much to the APSA Secretariat, Dr. Shem and Leonard Apio. You form the backbone of this organization, and your immense contribution to the organization of this event and your hard work throughout the year is deeply appreciated. If I could please call Dr. Shem and Leonard Apio to the stage, please. Leonard, don't be shy. What I must also add, these are two of the gentlest souls one could ever work with. It's really a pleasure to work with you, and it has been throughout the course of this year. Thank you very much. To our executive team, which includes, again, ACAPS from Morocco. It includes Namakau, Ntini from Zambia, who is our assistant treasurer, Mr. John Mugabo and Mrs. Faith Matamuriza from Rwanda, Mrs. Rita Nansasi and Benjamin from Uganda. Sorry, and they not all, that's one representative, but they alternate when they attend the meetings. So I'd just like to show the appreciation as well as Mr. Fuad Abo from Sierra Leone. Unfortunately, he's not with us. But could the other colleagues please come to the stage so that everyone can see who our executive is, please? So again, ACAPS again, please. Zambia is on the way. Thank you, Zambia. Rwanda, please. We're just waiting for Morocco. I think it's like, you know, the award ceremony. I think that Mr. Shafai is just tiring of coming to the stage all the time. But thank you very much, ladies and gentlemen, for your hard work throughout the course of the year and for making APSA the success that it is. Thank you very much. And a warm round of applause to our executive committee. Thank you. To the speakers, moderators, and panelists, thank you so much for ensuring that the content for this conference has been of a gold standard. Thank you for your willingness to share your expertise and knowledge so freely. It is immensely appreciated. Without you, this conference would also not be the success that it is. So thank you so incredibly much to all of you. And to our special guests, thank you so much for joining us and for all your support. Last but not least, to our members, the authorities, thank you for the role that you play in not only driving progress in your jurisdictions, but across the continent. May APSA grow from strength to strength to ensure that we have a resilient African pension landscape, adequate and sustainable pension coverage for all workers across the continent, ensuring a dignified retirement for all Africans, and ensuring Africa's sustainable economic growth. I thank you.
Thank you. Thank you so much. Okay, so before we come to the conclusion of this meeting, I was asked to make you guess the country where will take place the 2026 annual conference. Okay? So I've never been there. I was not gonna pretend that I knew the country, so I made one thing. I asked my AI so-called friend to give me some clues to make you guess the country. I will tell you the country, I know the name of the football team, all right? So, my AI so-called friend told me to do this. Use a calm, mysterious tone, increasing intensity with each line. Okay, so I'm gonna do this. It's a land where Golden Coast meet vibrant traditions. Come on. Well, it can fit with every kind of country near the coast. Okay? Home of Azonto beats, cocoa beans, and endless smiles. And the football team's called Black Stars. Ghana! Let's watch some pictures.
Landscapes. Ghana is located in West Africa, bordering the Gulf of Guinea and the Atlantic Ocean. With a total area of 238,535 square kilometers. Ghana is dominated by plains and low hills. Ghana has a diverse ecology, including coastlines, rainforests, wetlands, and grasslands. The history of Ghana stretches back to the ancient era, with the rise of early kingdoms and empires. The ancient era saw the development of kingdoms like the Soninka Kingdom of Ghana and the Ashanti Empire, which rose to power through trade and military might. European contact began in the 15th century when Portuguese traders arrived on the coast. This early contact paved the way for future colonial incursions. The British colonized Ghana in the late 19th century, establishing control over the coastal region. They renamed this area the Gold Coast due to its abundant gold resources. As the first sub-Saharan African nation to gain independence, Ghana became a model for African liberation movements. The World Bank estimates Ghana's total population to be about 34 million people. Ghana has one of the most robust and fastest growing economies in Africa. According to the World Bank, the country's GDP is roughly $73 billion as of 2022. Key economic sectors include agriculture, natural resources, industry, and services. Ghana is a country rich in cultural heritage, from its vibrant artistic traditions to its cherished rituals and customs. Ghanaian culture is a source of great pride and identity for its people. Its main ethnic groups each have their own unique cultural practices and belief systems as well. However, a national Ghanaian identity has emerged while still celebrating diversity. Respect for one's community and ancestors is an essential part of Ghanaian values. Ghana has an acclaimed artistic tradition spanning music, theatre, literature, and the visual arts. The country takes pride in its diversity while maintaining the connection to its traditions and ancestors. Ghanaian culture continues to inspire and bring people together.
And now, please welcome, as a conclusion, Mrs. Seham Ramli, Director of Communication and International Relations of ACAPS.
Well, thank you very much. Thank you, Faisal. And I think that Zarina has said everything, and it was really amazing. Thank you, Zarina, for what you said about the participant. And I would like, on behalf of the Supervisory Authority of Insurance and Social Welfare, to thank all participants for your active engagement and enthusiasm throughout this session. I think that we had a remarkable participation, and we hope you have built new connections that will support your work and that the knowledge gained will empower you to advance pension across Africa. And now, as we depart from here, let us carry forward the spirit of collaboration and innovation to support building resilience in Africa's pension landscape for the benefit of all our people. For those joining this afternoon social program, we look forward to spending more enjoyable moments together here in Marrakesh. Have safe travels going back home, and thank you once again.
Thank you. Thank you so much, Seham. So, before you leave for lunch, Mouna has some instructions for you. So, tu as besoin d'un micro. Tiens. Voilà.
Thank you. I have a very boring announcement to make. So, to all participants staying at the JAL Hotel, please, they are waiting for you for your checkout before lunch. So, we kindly ask you to check out right now. Thank you again. Sorry for this very boring announcement, and enjoy your meal. And we'll be waiting for you at 3:30 at the reception desk to start the excursion. Thank you.
Thank you, Mouna. Well, thank you, everybody. It was a great pleasure to be with you during these 2 days, and see you soon. Bye-bye.